We think that move in 23, 24 was the blow off.
Okay. Okay.
After that distribution zone from 2022 to 2023, where it stalled for a
Yeah.
couple of years in a range, it finally blew through that, like, oh, party's on forever. And then within a heartbeat, you're back to the highs again,
Yeah.
the 48.50 level. And so obviously, if you ever go back through that level again, the price guys are going to pull their hair out.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Michael Oliver, founder of Momentum Structural Analysis, is a leading expert in financial market trends. Known for his momentum-based analysis, he identifies key market shifts across commodities and equities. With decades of experience, we will be picking his brain and asking the questions that you submitted. Michael, thank you for coming back on the show.
Good to be back, Steve.
Yes, sir. Pleasure is all on this side of the table. Thank you for being had. Let's start out like we always do. And what is your macro view of the world economy and financial markets today?
The key thing that we're looking at now is we see macro technical evidence, and the fundamentals are bleeding obvious as well, that especially the stock market in the US, for a change, quite often it's other markets, has lived in a bubble. And the bubble is the biggest stock market bubble in US history in terms of duration, number of years up. It's 2009 to 2024, you count. The dimension of the move. The S&P was like an eightfold, ninefold move. For NASDAQ 100, it was like 18-fold advance in price. And all during that time, of course, if you'll look at certain charts from the St. Louis Fed, you'll see money supply increase, which it always does anyway, but at a higher rate than it normally does in any decade period. And two, they put money prices, in other words, the cost of money called interest, at Cheech and Chong high levels, the low levels, free money for about 10 of those 15 years, effectively zero rates. They raised rates briefly back in, was it 2000, 2001, 2, and then when COVID hit, they cut rates back down to zero again, kept them there again, another injection of happy money, and the market buoyed back up. However, we think it is now technically broken. And we have found in the past that whenever you make a major stock market top based on prior errors built into the market, whether it's the dot-com excess or the mortgage crisis that was building for years that the guys in the Big Short movie knew about several years before the event happened, finally it unfolded. So it's the events that have happened that people should be looking at, not on, oh, what's next? You'll find excuses here and there, maybe like we've got the recent tariff sell-off and so forth, but that's not the causal factor of a top if we're making one, which we think we are. Um, so don't be focused on today's headlines, and also don't be focused on what you think is the sole leadership, which it has been, and that's the AI stocks in recent years anyway. Uh, Watch other sectors in the market. There'll be vulnerability exposed there that will be headline type nature and ambush type in the way they appear. Like, oh, I didn't expect that type of thing. It always happens. So that's the context. Now, what that means is, and also we have another problem, especially in the US and Japan, government debt. I mean, there's only so many decades after decade after decade that you can keep doing what they've been doing and expect it just to be go on forever. Maybe is there a reality finally that catches up to you and says, nope, sorry, guy, you've made a mistake for too many decades. You have to pay your dues. The deck has to be cleaned. Now we have a U.S. government bond problem, especially the long end of the market. And that will have strangle effects on a lot of key sectors like commercial real estate, which I mentioned, which is something we're watching closely. Um, so it's a major financial and stock market bubble. It's not just stock market. Therefore, that's why, in hindsight, you can look back and say, "Oh, no wonder gold's been going up for 10 years." And now it's quadrupled, which sounds big, but it's nothing compared to prior bull markets. Uh, there's a lot of stuff going on here that's intertwined, in other words, that has an impact on something else. That's where I think our context is right now. And you need to have that in view when you're looking at a specific market.
Okay, I'm going to share my screen here to try to visually emphasize your point. So you're saying here from 2009 or so, this is the S&P 500.
Yeah,
We've
yeah,
just had a massive run up here, biggest
yeah.
bubble. And
Multi-wave. Hmm.
yeah, here's the M2 money supply. So this is going back to
Oh, that's nice.
1959,
Yeah, yeah.
just
Uh-huh.
skyrocketing up, right?
Yeah, yeah.
And then here is the Fed funds rate, which is some of what has caused this, where these two
Yeah.
yellow
Look,
arrows
even
are.
yeah, look at even at the recent high end of those rates, okay? Is
Yeah,
that high?
right.
That's in the
Compared
lower
to,
third of the past 50 years, 70 years of rates. So
yeah.
money's still cheap, even though they raised it.
Yeah,
Uh,
so these are the interest rates that people
yeah,
are, or I guess banks are able to borrow at. And
this is
so when
short
you
term. Yeah, this is
allow free
yeah.
money like this,
Mhm.
then things like this, the M2 money supply skyrockets,
You
which,
combine those two factors, and that creates wave effects, absolutely, and distortions of reality.
yeah, yeah,
And we're living in that. And so you've got to realize that's your context, not today's headline. Okay.
yes. Okay. All right, money supply go up, inflation go up.
Oh, yeah. Well, inflation, as defined by the Fed and most people, is erroneous. They look at things like, well, the price of consumer products went up or wholesale prices went up. And that's a tail end effect of ongoing monetary inflation. It's the increase in the money supply, and meaning the ongoing degradation in the real value of your money unit that's almost always going on at different paces sometimes, but it's an ongoing trend. And it reflects itself in prices. So when I was a kid, a loaf of bread was 20 cents. Okay. It's not anymore. Okay. Is that because we have a wheat drought? Okay. No, it's not. Your grandfather built the house, median price back then was probably $4,000. Right now it's 442,000. My, isn't that interesting? Well, degradation of the money in it. So the stock market goes up all during that time. Well, it doesn't, but that's another illusion about it going up. No, money supply is going up. In fact, it's tailing the growth in money supply, not ahead of it. And gold is an ongoing real asset that always holds its value. It'll ebb and flow. We've had a couple 50% bear markets. Remember 1975 peak to the 1976 low, a 50% drop. Then you went up to 1980. Then you dropped from 1980 and had even more than a 50% drop. Then you went up to 2011 peak. You had a 50% drop. Yeah. So anyway, but it's ongoing as a real asset. And the world's waking up to that. The US is probably the most lagged in that regard. That's for sure. But that reality is coming back. And when these crises that we talked about, like the stock market bubble, as it breaks, all the data points that the Fed likes to smile about smugly will suddenly go dark quickly. And then they'll have to alter their policy to accommodate the change in the data points. The stock market rarely ever goes down starting off with, oh, a bad collapse in the data points. No, the data points follow it. And then they have the other problem that they can't walk away from, and that is their own debt market is at the point of, you don't stop it, it's going to implode. Okay. And too many people have borrowed money based on long-term loans that are coming due in 25 and 26. I understand a lot of them commercial real estate. They can't take any more of that strangle effect of the long yields. So the Fed's got a dual crisis now, not just the Fed, but other major central banks. What are they going to do? Sit on their hands and watch it burn? No, of course not. They'll have to go berserk again, which they always do. The problem is when they go berserk, as they did in 2001, shortly after the high then, and they did in 2007, a month before the high, they cut rates, cut rates, cut rates. The market collapsed anyway. And right now we're playing this teeter-totter game, with Trump and, and Powell, which makes it even more interesting. But that's what we think the context is. So when you look at a given asset you might want to be in or be out of, put it in that context.
Okay, okay. You're comparing it against a currency that is just
Yeah,
continue to
it's
be there.
ongoing, and dues have to be paid sooner or later. And we've gone through these cycles before where dues get paid. Like, in the 1970s, the stock market was a total wasteland for a decade. You could have bought and sold it up and down, went nowhere. Total waste of, and the money supply increased during that time. So you're actually losing in real terms. But commodities exploded, and we had a global recession. And gold exploded, though we had a global recession. So all the things people think can't happen, happen. I think we're in that same context right now, except even more so.
Okay. All right. That kind of leads into Robert's question. He's asking about the S&P 500 and the Nasdaq 100. He says their momentum structures have broken in February. However, prices didn't continue to decline. Instead, these indexes are nearing new highs. What is the predictive significance of a downside momentum structure breakage only to have prices reverse and reach new highs?
Okay, let's go back in history now. First off, last weekend's report. I think you've got that.
Yep.
Page one. Now, again, this is as of last Friday, so what you're seeing is a few days old. Prices are a bit lower than they were then. If we were trading right now, especially, we have a holiday today. Okay. Futures are open, but the cash market's not. Okay, the price chart you see on the top is the weekly of the S&P going back to those lows in 2022. It was a very big downturn. It wasn't 50%. It was like a 20 some odd percent drop. Big drop though. And you turned up from 3,500 and went to 6,000 plus. And you did it in swings. You had some ups and downs, but you'll notice the momentum chart below. Now, what is the momentum chart? Scroll down a little. There you go, right there. This is what we call quarterly momentum. What we've done is the moving average you see on the price chart is a 3-quarter moving average, meaning at the end of each quarter, we average that quarter's average price with the prior quarters and the prior quarters and come up with a 3-quarter average. It's about the same time dimension as 200-day or 40-week. They're about the same duration of time. And then we oscillate the price action, these week-to-week price bars, in their relationship to, not like on the price chart where we just overlay the average. That's idiot stuff. It's the momentum chart. We oscillate the price in its relation to how much above, how much below that zero line, which is the moving average itself, is the action. And when you look at the two charts, you see harmony between 2022 up through about mid 2024, where price went up and so did momentum. But then suddenly in the last half of last year, as price continued to crawl higher, making people happy every other week with a new high, momentum was deteriorating.
Yeah.
Not enough for MSA to call a top, but we could clearly see topping type action. Now look at the red line on the momentum chart.
Okay.
That little short line. What that does is it connects a low weekly close with another one, with another one, with another one, with 5 low weekly closes, all line up almost perfectly. We draw that line in the very first week of January is where the first red circle is. Now go to the top chart and you
Okay.
see the first red. That's when that occurred. Now look, it broke that structure, taking out all prior low closes since 2024 for a whole year back, took out all the closes, plus it took out that little red trend line connecting all those closes. So we have a first structural breakage. So we call it momentum structure. Now you'll notice that momentum bounced from there and went up, not anywhere near back to the highs, but price nipped a new high. Oh boy, it's on again, right? No,
Yeah.
momentum is no. You broke your shin bone, okay? And in first week in March, you had another drop in the S&P, the second circle on both charts. Yeah, they're at that price level there. Now, in the lower circle on the momentum chart, you can see that there was a multi-point, a 4-point uptrend
Yeah.
going back to 2023 that goes through 4 sets of lows that you broke finally in that first week of March. So you had a second statement by momentum. Uh-oh, I'm breaking. Look at the price chart. For the next 2 weeks, it dropped a little bit and then puke. Okay, then we had news to explain it.
Yeah.
Okay. And then Trump came in like a shepherd waving his wand and calmed the sheep down and told them, no, we're going on a pause and all that. And said, oh, it's okay. as if that's the only thing that matters is current news. And we had a rebound. So far, it's not made it. By the way, that second circle on momentum on the S&P, that's when NASDAQ 100 broke its structure.
Mm.
So it was really in early March that we declared top in the market. Now, yes, we had a sharp drop. You'll see that S&P got down to 4,800 area. Now,
Okay.
we had predicted well before that low occurred that don't be shocked by a big bounce from the 4,800 level.
Yeah, we talked about that on this show.
Yeah, and on NASDAQ 100, we predicted was 16,500, and it got right to 16,500, and it bounced. Now, both of them since then, and this is again through last Friday, the chart you're looking at, we've come back but not made a new high on either one. Okay, no big deal. We don't care about price that much. Frankly, you could make a higher high on this momentum chart, and it wouldn't matter because the momentum chart would still be bumping the underside of that which it broke.
Yeah.
So now let's flip over to that next page, page 3 of that report.
Page 3.
Yeah, there we go. Now this is
There we
NASDAQ
go.
100 on an even longer term momentum study. Here we use a 100-week average, which is like 2 years, okay?
Okay.
Now, the zero line itself on the oscillator is not really that important. We broke below it in the recent break. But structurally speaking, the real structure that we look for, which is like repeated lows at the same level, like a floor or an uptrend. In this case, we had a floor. That red line on momentum is at 20% over that moving average. You hit it in 23 and 24 and 24, and you hit it like 1, 2, 3, 5 times
Yeah.
and define the structure. Now, when you look at the price chart, you can't see that structure. There's no
Yeah.
5-point structure, okay? Momentum gave you a beautiful structure. It says, don't break this. When you broke it, within 2 months, you'd collapsed fairly substantially, down to what we thought would be a bounce point that we pre-advertised as a bounce point, 16,500, and they nailed it just about perfectly. Now we've come back up in price. Now look at the price last week, got up very close to the highs.
Mm-hmm.
I was kind of hoping they'd make a new high to make people all happy again. Because when you look at momentum, it doesn't matter.
Yeah.
Okay? You didn't even quite get up to the resistance line. So maybe in a few weeks with that moving average rising, you can go up and make a new price high and still be bumping that broken floor on momentum. So this is how we see reality. Price is a reflection of the asset, but also the ongoing degradation in your yardstick. In this case, we're using dollars to measure the NASDAQ. In Japan, you use the yen, the euro, etc. All decaying units of measure. So that over even a span of a year, you could have a 10 or more percent change in the real value of the yardstick. Okay.
Yeah.
So what we try to do is slightly divorce ourselves from a price chart and take the dynamics of the market itself reflected in the change in its moving average, whether it rises sharply or doesn't rise at all, or goes down sharply, and oscillate price in relation to one of its own dynamics, namely its own momentum, which slightly gets you away from only using the money unit as your yardstick, which is a price chart. And it gives us a different picture. Now, if you looked at these two pictures, if I showed you the bottom chart and said, this is a price chart, what do you think? Okay, well, it's pretty obvious.
Yeah.
Most people would be kind of skeptical. But when they look at that price chart, if you made a new high, I bet a whole bunch of them would say, oh, happy times again.
Yeah. Yeah.
Okay. We think, now let's go back in history and look at the two most recent major bear market tops, or bull market tops in the S&P. That would be 2000. Yeah, there we go.
Okay.
This is monthly bars of the S&P 500 from 1998 through early 2001. The red arrow is the opening of January of 2000, of January of 2000, from 1998 to 2001. This is January of 2000. The S&P had closed on its high at the end of the prior year in December. We opened slightly up and it started down. At the first day of trading, we put out a report saying, okay, we're convinced we're making a top. Okay? Be gone. Get out of this asset category. Okay. You had a sharp drop in January and into February. Pretty
Hmm.
good percent drop, like a 10% plus drop. Bang, bang. Okay. And then it turned back up, and in March, you made a new high. And this is also true with the NASDAQ 100. It also made a new high. It was the dot-com index back then. But here we're looking at S&P. Okay, so we said get out at the arrow. Okay, if you're an investor and you got out, well, okay, you felt like God in March. They were wrong. We reiterated, no, this is a topping action. And look how laborious it was. You made a high in March, and again you dropped down almost to the February low. And then he came all the way back up in August and made a new high monthly close. So it's now 1, 2, 3, 4, 5, 6, 7, 8 months after we said sell. And then into September, you came up, made a slightly, not a higher high, but higher than the August close. And then you started down. Nothing dramatic. You came down and nipped out the early year lows. And we show through March of 2001, if you'll go to the January 2001, the three bars inward, where you had an up bar, and that one there, yeah. In that month, the Fed started cutting rates. In fact, they cut rates twice in that month. And look what the market did. Oh boy, party on again. The Fed's going to save us. Okay, we don't show what happened here, but you got cut in half. You went down into the 700s here, okay,
Okay.
by 2002. But even after they cut rates twice in 1 month, the market said, who cares? And in fact, the last rate cut was at the end of that month. So about where you closed January, which looked kind of good, right? You
Yeah.
immediately started down the next month and you went off the page. We don't show that. Okay, so don't be happy if the Fed starts cutting rates. Okay, it's not a good sign. But the point here is topping in the stock market is often arduous. And while MSA might peg a point to exit, it might not be the best place to buy a put that expires in 2 months. Okay.
Yeah.
From an investment point of view, it was a good place to get out after we'd gotten bullish. And by the way, in early 95, way below this chart. And we got bearish at that red arrow. Now drop down below and you'll see the 2007 top. Okay, now here we go. Monthly price again of the S&P. We start in 2006 and move up to the 2000. The red arrow there, the horizontal arrow.
Hmm.
If you traced it all the way back to the left, you'd go all the way back to the year 2000 and you'd see there was a peak there at 1553, the chart we saw above. The peak trade was 1553 at the dot-com top. Notice the circled on that red arrow there, the second circle is at the July high in 2007. It took it out by 2 points. You got the 1555. Okay, so you basically double topped at the 2000 high. So no doubt some price chartist said, hey, I'm going to short it here and risk a nickel. Okay, and he made some money. You had a good drop. You had a couple 100-point drop there into August. Now that unnerved Bernanke a bit. Because all during this time, he was telling us, like Powell's telling us today, everything's fine. The mortgage crisis is totally controllable. In fact, it's not even a crisis, he said. Okay, that's the August low, September. Now, the next bar off that sharp low is September. Now, about midpoint in that month at about 1500 price level, the Fed cut rates surprisingly. Nobody expected it. The half a basis point cut. About 3 weeks later, you punched out above the high that had occurred earlier in 2007 and the high of 2000. So you had what you would call a triple top price breakout
Yeah.
spanning 7 years, the 2000 high, the 2007 high, and you broke out shortly after the Fed cut rates. So if you were a price chartist and a believer that the central bank could print you up forever, you were happy. Okay. And then the bear market started. Okay. They cut rates all the way down and we went to hell off the page there.
Yeah.
Now go back to the little red circle on the price chart. That's December of 2016. And basically our last report of that year, I'll quote from it. We talked about what 2007 would look like. Again, you're dealing with a market that's in the lower to mid 1400s then, still short of the 2000 high, which had been 1553. Okay, so we're still 100 some odd points short of getting to that old high. We said To continue to see an objective for this move, probably that external high is somewhere between the old S&P price highs at just above 1550 and close to 1600. So in other words, we were arguing a year, December of 6, that we'd likely make an ultimate high that would take out the 2000 high at 1550s and get in between 1550 and 1600. Those were our numbers. The high was 1575. Okay.
That's pretty
Yeah. Okay.
accurate.
Now look at the price chart. If you're a price guy and you look at that, say, hey, man, it's fine. Had a big break, took out the 2007 high, took out the 2000 price high. Wow, we're on. The game is on, right?
Mhm.
Momentum was chuckling the whole time. I don't have the momentum charts here, but it was based on momentum that we said, this is no good. This is a topping pattern. But look how laborious it was. I mean, that 1550 level, 1, 2, 3, 4, 5, 6, 7, 8 months traded over 1500 there in that process. And it stayed up there for a couple of months after we had reached our target. And really, it didn't start to come apart until the summer of 2008.
Yeah.
You had a reach back rally in early 2008 that got you back to unchanged on the year. But anyway, but the point being, it's arduous.
Yeah. Yeah.
And often you make a new price high. Now, so far, our current market hasn't done that. All we've done is bounce from a predicted point up to a level that I don't know if it'll stop the market or not, or whether we roll over now and just fail to make a new high. Either way, I don't care because momentum says do not trust this market. And also assume, and this is our technical assumption, this is the biggest bubble measurable by time or percent gain and distortion by monetary factors that we've ever seen. Hence, the bear market that follows could be pretty bad. And it won't just reflect itself in a certain limited area of the stock market. It's going to show itself across the board in areas that you weren't thinking about as leadership. Like we keep talking about commercial real estate, hence banks would be a consequence of a commercial real estate problem. So keep your eyes wide and also keep your eyes on the bond market. U.S. Treasuries, 30-year bonds, futures. They're laboring near lows of the last several years. They can't seem to get off the lows, meaning yields can't seem to drop back down.
Yeah.
And the Fed's going to panic if they don't stop that thing. And what does that mean? Well, ultimately, there's going to be repercussions in the real world, as we call it, the stock market and companies, et cetera, where they have to go in and print, which never succeeds. All it does is hasten the ongoing bull trend in gold. I think that's a context win. Laborious top in the stock market, yet to be fully exposed to the public, but I think it's coming.
Okay. All right. So basically, although we may see a new price high, your momentum analysis is showing that it really doesn't matter.
Don't trust it if it occurs, and I'm not even sure it will. I thought hopefully recently they would do it because Trump would say something that made him feel happy.
Yeah.
He's a tape watcher. We've been told that he watches the stock market closely, so it's like an audience for him. He likes it when it upticks. And anyway, he doesn't realize, obviously he's not dealing with quote his market any more than Biden was dealing with his. If Biden were such an unsuccessful president, why did the stock market go up all during his term? Well, because they were printing money. It had nothing to do with him. Okay.
Yeah.
And Trump is telling the Fed cut rates by 2 points. Okay. Well, he's the same orchestra again, print. Okay. So ultimately, the Fed will print, and these factors will cause them to print and to do things like QE again and so forth. In fact, the head of the Boston Fed, I forget her name, about 2 months ago had a press conference, and it was a week after Powell had had his normal conference where he said everything's fine. She said, in regard to financial problems, she didn't define what those were, we have multiple tools to deploy. What? Why would you be talking about something like that if everything's great? Multiple tools doesn't just mean interest rates. It means, QE again, huh? Oh, wow. What was she talking about? What was she concerned about? And I bet that she didn't do that off the cuff. She had approval to make such a statement. That's what the public should be focused on, not his comfy statements. But why would she make a statement like that? We'll see.
Yeah. Yes. Okay, so Frank has a question about David Hunter. So David Hunter's been predicting a blow off top. After what you said, I'm guessing that you don't see a blow off
No,
top coming.
in the stock market, no. I
Okay.
think you've had it. Um, in fact, go back. You had the very first chart you showed was on your quote screen of the S&P 2009 to the present.
Mm-hmm. Okay.
Put that up there. Okay, now we think that tail end stuff you just saw after the 2020 22 high, which is at 4,800 plus.
Yeah.
The way that's where we bounced from. In other words, that high in 2022 at 4850 area.
Oh,
Uh,
okay.
yeah, no, you went through it there. That's 23, 24. Yeah, that high. Draw a
Okay.
horizontal through there. You'll stop right on it. We thought that might be one of the factors that created a bounce, meaning, pardon me for saying this, an idiot chart.
Yeah.
Which any idiot with a crayon look at an S&P chart could draw a line there and buy it and think he's going to go rich forever because this seems to be the pattern forever, right? It hits the prior high, goes up forever. We think that move in 23, 24 was the blow off.
Okay. Okay.
After that distribution zone from 2022 to 2023, where it stalled for a
Yeah.
couple of years in a range, it finally blew through that, like, oh, party's on forever. And then within a heartbeat, you're back to the highs again,
Yeah.
the 4850 level. And so obviously, if you ever go back through that level again, the price guys are going to pull their hair out. Okay. Momentum says get ready for that.
Yeah.
That was your blow off top.
Okay.
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 Okay. Anyway, that's my answer to that question.
Okay. So Hunter was right, and he was right here, but you don't see this continuing.
No, I don't see another game here. And in fact, if you do nip out the high, I'd be looking for any short-term failure after a new high, something even like a weekly type downturn to assume, okay, it's a teaser.
Yeah.
It's going to fail from here. Or you simply don't make a new high.
Okay.
Six
Okay.
of one, half dozen of the other, really, in terms of percentages.
Okay. Um, we have a question here from Alamo. He says, how much downside in percentage terms would gold need to correct to break your long-term bull trend in momentum? So here's the
Okay,
gold price chart.
we go back to 2015. Go a little, there you go. Okay, now there from 2000, first off, in 2011, when it made the high at 1920,
Mm-hmm.
a few months after that, just a couple bars after that high, we got major bearish on gold. Okay, we said, that's it. Sorry, guys. And we had subscribers complaining over the next year that, oh, no, it's just congestion zone. We said, no, it's not. I'm sorry, it's a top. But look how laborious that top was.
Yeah.
You never came back to the high again, but you just sat there between the upper 1700s and the upper 1500s for a year and a half
Yeah.
after that high. Like, I'm comfy. We said, no, I'm sorry. Annual momentum broke a structure. It wasn't until April 2012, excuse me, 13, that you finally broke that price pattern, but also started down and pay the dues for the momentum breakage. To go down to the 15 low, late 2015. Yeah. 2 months after that low, we turned major long-term bullish on gold at a price of 1140, 90 bucks off the low, based on the same annual momentum metrics, even longer term than the quarterly we've been looking at on the S&P. And nothing since then has caused us to change our annual momentum assessment of gold. Right now, you'd have to go down so far in price, like 22 to 2400, to break annual momentum.
Okay.
You're
Okay.
not even close to it. It is our experience, as was the 2011 top, the 2016 upturn, when you make an annual momentum breakage and turn and trend in that metric, it's almost always fairly close to what had been the high or the low. Right now, the breakage point is so far off the high that it's meaningless.
Okay.
Now, I have another opinion, and this is based on macro, technical, and fundamentals. This is a different bull market in gold. Just like if we have the stock bear market that I'm talking about, it's from a different type of blow. bubble than we've ever had. In the case of gold, I don't think we're going to go up and collapse, nor do I think silver is going to go up big and collapse, like, let's say, the 1975 peak in gold that got cut in half, or
Yeah.
that 2011 peak that got cut in half. So far, the biggest drop we've had in this entire bull is a 20% drop, and that occurred at that 2022 low, when we got down to about 1600.
Yeah, right down here. I
Yeah,
remember that one.
that
Yeah.
was measured from top tick to low tick. It was that was only a 20% drop. In fact,
Okay.
the S&P has that all the time. So the gold guys were crazy. It's all over, man. We said, no, it's a bear trap. You took out a bunch of price lows when you came down there. Again, I'm looking at price now. See the lows that
Yeah.
occurred? Yeah. In the 2 years prior to that break, you'd made lows in the upper 1600s
Yeah.
repeatedly. You came down, hit the upper 1600s there as well. No, wait, go back a few more months. Just, yeah, come on down, 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 right about there. In the summer, you hit again the upper 1600s,
Yeah.
1680s, and they bought it. Then it failed and broke through that.
Yeah.
Okay. If you sold that quote price breakout, you got killed.
Mm-hmm.
It was a bear trap. They had you back to the highs within, a handful of months. Okay. And anyway, but right now I'm arguing we're nowhere near any kind of breakage on long-term momentum of gold. And given the history of gold, whenever it makes a major top or low, it's almost always in close proximity to breaking momentum at the same time. We're nowhere near momentum structures. This is a pause,
Okay.
quite
Okay.
quite strong one. Gold doesn't tend to peak, by the way. Look at that 2011 peak, or the 2020, the 2011 high. It was brief, boom. You never
Yeah.
came back. Okay.
Yeah.
Look at the one in 2020 when we surged up over 2000.
Yeah.
You came back up to it again a
Yeah.
year later. You shouldn't have come back up that second time in 2022, 23, or the early 23. You should not have come back up there. When you come back to an old high in gold, it says, I'm coming through. You don't top that way. You came back up again, again, like 4 times you came up there. And the message is, I'm coming through here. This is a launch pad.
Yeah.
And I think we're now coming out of another mini MINI launch pad that's been in place since April, where we've gone up and down, up and down, up and down. In fact, if you can go to a weekly chart of gold, you'll see what I'm talking about.
Okay. This is weekly. I just got to
Oh,
see
that's
what
weekly?
one.
Okay.
Yeah.
Now, if you go to can you do a close only? Weekly
Close
closes?
only. Oh,
See if you
man.
can do it.
I've never
Close.
done that. I'm
Oh,
sure
okay.
this
Well,
program can do it,
you'll,
but it's the right side of
okay,
every
yeah,
bar.
the
Yeah.
little, if you'll notice the little bars, not the up down bar, but the sideways bars, you'll see there's so many of them that they're in the 3340, 3350 level. It's like you came up like 1, 2, 3 times up there.
Yeah.
That's persistence. That's not a top. Gold doesn't top that way.
Okay. Okay.
That's a fist, okay?
Yeah.
And I think you're going to emerge up through it, and it's emerging slowly. And that's allowing silver to do a snap up, by the way, catch up to gold. Silver's not been going up slowly. Silver's gone up quite a bit. Uh, anyway, I think we're at the point now when gold surges this next time, this next up move, whether you go to 10,000 or even higher because of the crisis that's going to hit. Uh, I don't think you're coming back down again. I think what's going to happen is the world will shift in phases, this country, that country, et cetera, to a real money backed currency. We've had fiat for, quite a few decades, and it simply hasn't worked. It's merely created monetary boom busts. And once the realization hits that, hey, it didn't work again, only this time it really didn't work big time when the bubble breaks, stock bubble, other assets. Stability in Forex will be a goal, and there's only one way to do that, and that's to go back again to a gold or silver-backed money units. And again, it's not going to be global at once, or the US probably won't lead the game, but the factors that we've been talking about that will create real world consequences of pain will cause a populace to demand some kind of change.
Okay. So,
So I think when gold goes up the next time, you might just be priced at a certain level,
yeah. Okay. So
government.
basically, since back here in 2015, you've
Yeah.
been a few dollars off the low. You've been bullish on gold, and
Yeah.
unless it comes back down here to the
Yeah,
22 to
that'll rise.
2400 range,
That'll
momentum
rise.
is not broken. So it's
No,
so
no, you
far
gotta.
below here, we don't even have to
No,
worry.
it's yeah, you can have sharp breaks, and we try to have them. You'll notice on the way up here since 2024, when we emerged through that gunk in the mid 2000s,
Yeah,
it's had upturns with congestions, upturns with
yeah,
congestion. Now suddenly you have a bigger upturn.
yeah,
And if you come out of this congestion, which again is congestion, it's not a spike top.
yeah,
Uh, you made new high monthly close, about to make one, and you made a new high weekly close last week. This is congestion. This is not the way gold tops.
yeah,
This
yeah.
is this is another mini launch pad. But this time I think it's going to be far more dramatic. And there's some reasons I think that. I think the evidence is coming from the gold miners and also coming from silver that something this move is about to get very aggressive.
We're going to break this into two parts. When we come back, we will talk more about gold and silver miners, the dollar index, platinum, commercial real estate, and emerging markets. Subscribe if you haven't already, and hit that little bell notification icon so you know when part two comes out. Thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.